98% of the market is held within the Russell 3000, but imagine if your favorite sports team only had 45% of the players ready to go. It's unlikely you'd win. That's the situation we face the markets with right now. In February, during the highs, we saw 70% of the market above the 200-day moving average. Now, we only have 45%, yet we've returned to the same point. So what does this mean for markets? Well, it shows us that unhealthy stocks are still unhealthy and that maybe there's a little bit too much rally in the top end. Today, we'll talk about the rallies moving into Q1 earnings and what the statistics show us when we get an incredible march into the Q1. It might surprise you what the results look like. Let's get into it. Well, welcome back everyone to the Daily Show where we talk about stocks, commodities, and cryptos. If it's your first time here, welcome to the channel. Consider subscribing and smash that like button if you find value in today's video. But we'll begin with the macro, the news, then we'll go into the lead indicators and of course the hottest charts. So fear and greed index, well, it's changed all the way up to almost extreme greed again. 70 is the reading we're currently getting, and this means we need to start thinking about putting on the brakes and being a little bit more cautious in markets. Only a month ago, we got a fear reading. Now we're almost in extreme greed. And that's thanks to so many of these indicators coming back in what many people are calling the V-shaped reversal. So what about stock price breadth? Today, we'll take a deep dive into that, but I want to bring up some Q1 stats that I think will really surprise you leading into today's earnings report and in fact, the next couple of weeks. If you haven't actually followed us over on Twitter as well, we have posted a couple of charts, and I thought the first one we'd bring up is, of course, not necessarily an extreme timing tool, but something that gives us, again, another reason to say, well, we need to be cautious at these highs, and that's smart money versus dumb money inflows. Now, we've used this in 2022 and 23 quite effectively to find and pinpoint highs. And while it didn't get exactly the points, maybe 100 points wrong, you did end up getting very interesting swing levels. And what we're looking for is generally dumb money, which is this line here, to overtake smart money and smart money to drop off. And we're getting similar readings here to what we had, of course, previously back over in January and February. Those readings ended up being correct. The market fell off, and now we find ourselves at the peak ahead of earnings season. Let's now scroll over to, of course, another thing that's going to become a big point of contention, I would say, over the next couple of months. 91.7% of all economists out there now believe we're getting a 25 basis point hike. And remember, the markets have been going up into these earnings while we're also seeing interest rates increasing. Now, that's never been a good sign over the last 12 to 14 months either, so we'll need to look at that a little bit later. They're kind of mean reverting at this stage. I also find this hilarious, which is basically if we go back in the articles, remember the Fed said about a week ago due to the minutes that there was going to be a mild recession. Where have we heard that before? 2008. Yeah, I never like it when they say anything or they admit there's a problem in the economy. It usually means there's something a little bit worse behind. But we always do remain optimistic on markets, especially when we don't have incredible problems in retail property debt just yet. Let's talk about good earnings seasons and whether they're already baked in. We've actually seen the 14th best since 1950 run up into Q1 earnings. Now, that's pretty surprising because when we get such incredible runs up, it could be a buy the rumor and sell the fact. Here are some stats behind buy the rumor and sell the fact. And the first stat is what happens a week later after we get readings such as this. Well, you can see here's a reading. Here are some of the other readings. Do they look familiar? Some of the bad times in markets. And actually a week later, less than a coin flip at the time, the markets are up. Now, if you know anything about statistics in markets, usually around 68% of the time per day, markets are bullish. So whenever you're getting stats that are showing you less than that, usually it means it's a murky period of time. And actually 6 months later after a reading like this, we're only at 57% bullish during that period. Let's now move over to some other stats though. What about the sector performance leading in and after this? Well, here is the sector performance when we consider all of pre-earnings season runs. So this is Q1, Q2, Q3, or Q4. And you'll notice that communications, healthcare, they tend to be the two worst performing sectors. And it's interesting that small caps actually do better. Now, they've been lagging recently. So is it time for small caps to actually break out regardless of the bigger caps coming down? And we'll look at that one a little bit later on. When we actually pull out the data, though, and we start to say, well, what about if this is the kind of best earnings return over the first quarter? Then you'll notice here Q1 reportings, which begin in, of course, April, which we're at right now. When we get these types of big run-ins, look at that, 22%. All of a sudden, we go from 50s and 60s. We go to the next 6 months only being up 33% of the time. And that could really lead into some of the things that we talk about with ERP and basically a kangaroo or even downtrodden market due to the mild recession that could be coming soon. What about which sectors have done best and worst? Well, it's across the board negative, at least over the next couple of weeks. And the next 6 months were pretty dire for things like value stocks and growth stocks alike, including cyclicals. Now, notice communications. That's the one that seems to be the lead here in both scenarios. So we might look at XLC a little bit later on. It's been one of the best sectors recently. Before we mentioned the concept of smart money versus dumb money. Now, I consider us retail traders, unfortunately, we're often considered the dumb money. And although we're getting smarter all the time, thanks to hopefully the community here and of course channels out there and information that's now being spread throughout Twitter and other things, we still don't really have a full impact on the markets in terms of understanding everything else. It takes time, it takes years, and of course, it's not easy. So 39.5% of people voted neutral last week. We're going to get an update on this sometime around Thursday and Friday this week as of Tuesday. And what I'd be liking to see is more people going bullish, more people neutral, less people bearish. If that's the type of read we're getting, very good chance the markets will actually decline. Because it means they've trapped people into this kind of concept that everything's great right now into earnings season, which is still expected to not necessarily be very good. It's meant to show declines. The last hour of trade is something we've followed recently. We have continued to see buying into the end, which is usually historically with, I would say, big funds kind of going through. Maybe zero DTEs have changed this a little bit. Maybe it's just hedging off. But yeah, we've seen basically a lot of buying into the close. Again, the first couple of weeks from that read tend to be a little bit murky. All of the rest of the stuff here, such as the gold kind of being in a sideways style market for now, we've talked about before. Just remember, we will, if you're a big gold player, we will update this chart later on this week, which will show us where the big players are actually declining their purchasing power. And if they are, we consider that we're probably going into a distribution period for that. What about the stock market inflows? We've seen managed funds kind of neutralizing anywhere between 600 and 400,000. I consider a neutral market. That's where they're hedging their bets. They're saying, yes, I have to be in because I can't miss the rally. That's the worst thing any fund manager can do, miss significant rallies or miss recovery periods. But they're not prepared to put all their eggs into the basket just yet. And on the leverage side, these guys are actually getting more and more desperate for the market to sell off. They're actually increasing their short hedges at a pretty drastic rate here over this current rally that's happened in March. They're basically saying something's wrong. We're going to bet against the market, and they're betting against it similar to August of last year. Now, we all know what happened there, but these are some of the things that are starting to play through. ERP, I talk about this all the time. I've spoken to some pretty significant players in the bonds game, and most of them believe that it's not really worth necessarily chasing too many risky investments right now unless you're guaranteeing kind of like over 9%. And that's really the reason for that is because bonds or ERP are becoming so tight. We haven't seen such a thing in over a decade. We've never seen ERP this low. But when we get these types of reads, it usually means, and this is when we go underneath the 1.7 reading here, this happens 35% of the time in markets over 60, 70, 80 years. However, it doesn't usually lead to significantly great returns in stock markets. So that's why they're saying that you need to get higher returns, because the average return expectation here is getting worse all the time. Basically, the risk is not necessarily worth the premium of how much you're going to be making. ERP should also go up in recessions. The Fed has already told us that we're getting a mild recession. So theoretically, we should see this spike out and potentially stocks actually reduce from that point. Now, banks have started earnings and they've been okay. Big banks have done quite well. Small banks have seen some rallies so far, to be determined. But I think the interest probably is moving still to small banks. And we're going to also be looking at Tesla and Netflix. Tesla could show us demand destruction in play. We know there's a lot of cuts coming in for their cars. So potentially that means that there's a lot of pressure on earnings. It could also mean that they've just saved so much money due to the demand destruction across the board and also shipping costs and everything else coming down. So Tesla, I think all eyes will be on that one in particular. And maybe the market is waiting for Netflix or Tesla to be able to breach up or breach down from this incredibly tight coil that we're starting to see here on markets. So what was the best returner over the last 24 hours? Well, it was regional banks followed by solar, financials, some of the hated sectors recently. They're all going up. But at the same time, we're seeing a reduction in some of the most popular ones over the last couple of weeks. Technology barely up and communications only down 0.57. Gold also struggling at 2.25%. When we take a look at this over the next 5 days or the last 5 days, you'll see here again, the story is basically the same. Communications and technology have stopped. They've completely stopped. They're not leading the market anymore. The market is now being led by financials and some other kind of smaller stock markets. Things like Russell as well is coming back a little bit, but it's at critical right now. So let's talk about the Russell. Let's get into these charts. And we'll start off here. This is the big one. When you have a breadth that is not increasing, it is not necessarily a positive sign for the recovery. 70% of stocks were trading above the 200-day moving average. Now it's only 45%. So what that's showing us is that the big stocks are leading the way, which is fairly normal, and small stocks are still lagging. Basically, the bad stocks are still bad, and the good stocks maybe are a little bit expensive. That's what this China chart is showing us about this recovery so far. And we will need to pay a lot of attention to this because this is one of those warning signs. We're also seeing the Qs, that is the NASDAQ versus the SPY, changing. So you can see here that recently the SPY is actually outperforming the NASDAQ while the NASDAQ is losing some ground. And this was where the big recovery was recently. We saw that trend line get smashed. It went boom, 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 hit this resistance over here or the supply over here, and then the market has gone down a little bit. So if we look at maybe this a little bit differently and we look at US 30 versus US 100, what you'll also notice is that we're seeing a bit of a switch here where the Dow is starting to outperform the US 100 as well. So the NASDAQ is definitely not leading at this stage. We're also looking at XLY versus XLP, which shows us the American consumer. And this is still, relatively speaking, negative. So we're basically seeing an economy that's supposedly in great recovery and everything like that, according to the market. But we're seeing 1/3 of the US economy, which is consumer discretionary, not outperforming the market overall, and specifically not outperforming its peer, which is consumer staples. Basically, we want to see that outperform to show us that this is a strong recovery and the American consumers coming back. It doesn't look like it probably is, and this chart is showing that. Let's move over now to some other signs of maybe complacency in the market. So for a long time now, basically all of 2022 into 23, we've had to pay a lot of attention to the VIX when it gets low. Now, a lot of people will say zero DTEs, Tom, don't worry about it. This thing doesn't mean anything anymore. Yeah, I get that, but we just still have seen spike. We got our normal Q1 spike. So that's pretty damn normal. We usually see a huge VIX spike over the first quarter. That did lead to a sell-off, and the sell-off was pretty significant. I mean, we went from 4,200 all the way down to 3,800s. So pretty significant sell-off. Now we face a new low. So basically the VIX is going back down. Now where all of this started, if you can see here, which was January of 22, we had a 16.33-ish or 37-ish VIX. And I've had this on my chart now for ages. So is the VIX going to go down to 16.37, complete complacency, and then all of a sudden we'll see a spike? You don't really want to be necessarily buying stocks, at least the way that I look at it, when the VIX is so low. Yes, that means that we could be in a new bull market and everything's great, but it's not really the greatest sign. PCC or put call ratio is also something we can usually time with this. We like to see put call ratio, of course, down low. It's more of a counter kind of mechanism. So we're looking for lack of puts and tons of calls. Now, put call ratio is way less useful than it used to be. So that's why we don't bring it up much. But we did see a read here that was at the 0.9s, and I'd like to see put call ratio decline. If it does decline, it's another sign that we need to be extremely cautious in markets at this stage. Copper also has had another day down on it. Now, we know that Dr. Copper is something we're watching over here in January. I kind of called the high for copper. We've seen it kind of struggling around. I didn't like what it did here, but it ended up holding the weekly down, which is really nice. So you can see here the weekly did not manage to bust through that 4.1261. So we have to assume that copper is still negative at this stage. And if it does start to fall away, that's showing us the world economy in general is weak. So remember, copper traders usually sniff it out pretty fast. If they don't like what they see, you should see it reflected here, and it's another not good sign for the markets. Another point of contention will be things like high yield junk bonds. We haven't seen them recovering with the market recently. If these continue to drop off and the market keeps going up, bad sign, yeah? So it's just not a positive sign, and we need to be watching that as closely as we can. Let's have a look at the US dollar. So it found that recovery up into this area. So we've seen now a declining trend line that held this market back in terms of the US dollar. Most articles now are saying the dollar's under fire, the dollar's getting destroyed, all these types of things. Look, it's also about yields. I mean, we've seen yields switch to being a bit more positive in the last couple of days, thanks to every economist in the world now believing we're getting a 25 basis point hike. That strengthened the dollar as well, plus it was probably oversold. And we're back now in this supply. So if you're going to be a dollar seller, somewhere in here is theoretically where you should start to see some selling. We're looking for it. We haven't seen it yet, but this was certainly one of our highlighted zones on the weekend video, and we're here right now. So what I'm really looking for is jumping into the small time frames, and basically you're kind of looking for a switch. So there's a small switch that's just occurred. You could get a rally into London, maybe pushing through something like 101875 and then maybe even further sell-offs. I would like to see more. I wouldn't even mind something like that, and that would show us further weakness in the dollar. And not necessarily one over either way. We're just looking for, of course, the reaction, and we haven't got that just yet. Now, we did see some strong or nice kind of moves on gold. Gold fell down to one of our loved levels, which is down here, that 1980, between 1980 and 1975. So this is where we've liked gold. If you're actually a bull on gold, you now need this thing above 2015. So if it takes out this previous high, that's going to be a super positive sign for gold, at least for now. What you don't want gold to do is go back under this zone and not find instant buyers. In here, there are buyers. That's where the demand has been. We've talked about it now for quite some period of time. If gold struggles through there, and let's say dollar index continues to bust higher, maybe it breaks our trend line down, all sorts of things like that, then gold will most likely go into more sideways action, distribution, similar to what we've seen. Remember, weekly did not hold above. We talked about the data stats that do not look positive for gold right now, although I am a gold bull over the next coming years. I just think that this could be a struggling point for it, and it makes sense. Everybody's on the trade. Remember, we were on the trade over here a long time ago talking about it. And we obviously were super bullish on gold back in the late last year. So, I'm super bull on gold generally. I just think that it's coming to, a very big point here. And you've got a high at the moment. You have a low, you have a higher high. We're looking for that lower low if you're a bear, and then maybe pullbacks into, some distribution. So be careful here on this one. Weekly closes will be key, and we haven't seen it yet. Now, our natural gas moves have been pretty good recently. We have seen those lows being taken several times. That's led to a slingshot. We've been bullish on it on the bottom here. It is the Widowmaker. Remember, it moves a hell of a lot per day. But let's take a look at this on the weekly. It's a fairly significant move out here if it can hold this week. And if we go to the 2 hour, I wouldn't be surprised at all to feel something like this gap in here. However, I do think bulls have returned at this stage to natural gas. It's pretty heavily sold off. And this steel here and this steel here were pretty nasty. So I'm sure they made a few people sad-faced because they would have taken those positions off them. But yeah, look, natural gas, we had an aim for 2.461. It's pretty close now. I'd like to see it continue its base and maybe move down and then like up like that. That would be kind of an ideal thing here for natural gas. Nice move. Let's look at oil. Now, I don't want to say anything in particular, but well done, guys. I put here a line and the scalp zone, and obviously we updated that, and you can see what happened here. It came right down to that level and actually found instant buyers. Now, we did expect buyers in this zone here, so that's not surprising. Let's take a look at the smaller price action. Oil is kind of doing what we expected. It needs to find buyers right in this zone, though. So if we go to the daily, this will look like a massive breakout to a lot, and of course it is. It's higher than all these points. But we've got to be very, very cautious. If you're actually feeling like you want to go short on oil, there could be an amazing swing trade coming up where basically we look for lower low and then more of a turn towards the short side, something like that. This level is super paramount that the bulls hold it. So the bulls must hold here. This makes the most amount of sense to see buyers recommence. And I think a lot of people understand why. They've been following the channel for a while. So far, so good. This is the right type of switch that we've seen. And I'd like to see buyers recommence here in oil, at least temporarily. What would the targets be? I think it's pretty clear this is a key zone with a nice level of supply. So, for scalpers, they're probably looking at, trying to get it back into this 82 zone or 81.80 to 82. These are the previous supports, and you can see kind of where those buyers might kind of lose some faith in oil. Nice trading though, and it's good to see a zone that we've marked out on these charts together getting hit so perfectly. Tesla coming into earnings, I got to say that is neutral as neutral can be. The markets have not given us anything. They're not giving us any edge. Look at this, even a long leg doji on Tesla. So we've got high level extremes. We have the low level stop loss extremes. If you're a Tesla buyer, you're kind of looking for it to go take this level and find instant buyers. If it does, that's probably done some stop loss hunting. If it has done stop loss hunting, that's a good sign for you as a buyer after earnings. So of course, reaction is better. The markets are expecting quite a big range here, as we saw on that chart before. So we know that Tesla's expected to have a fairly volatile earnings report. We also have the top end here where rallies might be faded back off. So you've got to be careful here at just around 195 to 200 will be critical. And then I like this low here, which was being demanded a lot. So if the markets go underneath and instantly bounce, that's something I'm looking for. If markets end up closing below, it probably means rallies will be met by more sell demand, and we might finally get that 145 that we've been looking for a little while after it went past 210 plus. What about the options? Not much to go off here. It is third week options expiration. Just remember, we've got a lot of 200s and a lot of 150s. So everything in here is fair game, at least how I see it here from the options charts. Let's move over to some other stocks leading into earnings. I mean, Apple has been the one that has always rallied. It's always rallied, and it's always come to this trend line throughout 2022, and this is where it has failed. Now, we've seen different types of turnarounds. We've had double tops, similar to this one. We've had kind of like a gap down and then a fill of that gap, and then it just sells off completely. But this trend line has stopped everything in its tracks. So I think Apple is something of interest. We don't have any turn story. The trend is still up at this stage. It is just waiting and seeing. There's nothing we can do there. CQQQ, so this is the Chinese technology stocks. You can see they're actually a lot better looking from a investor standpoint, theoretically, than maybe the American stocks at the moment. But we find ourselves in some nice chop. It's come back to probably about a 50 or a 61.8 of that low. So maybe there's some buyers here, but at this stage, nothing much. Most people are just seeing it as an inverse head and shoulders. I don't disagree with them. 52 will be a critical level moving forward. If that breaches, then it should be, more positive, I guess, on this chart. We've seen, of course, XLC not doing so well. So let's actually load up that and we'll look at that one. You can see there's semiconductors. Look at where XLC is. Communications have come straight into this high. So if we drew a little box here, which we'll do together right now, we need to get a box, guys. There we go. And if we just draw a little box there, you can see these highs and what's happened in the past. Look at the critical zone we find ourselves at, right into earnings. No surprise, we're at all of these tight zones. So this area here, if we breach up, then we probably probably are looking for further rallies, though I'll be looking at the indices overall from doing it. But XLC's kind of started to slow down. It's no longer leading the market with technology and the others. If you look at the Dow, the DAX here, if we go and have a look at the DAX, you can see the long leg doji. It's reached up as high as 15.9. I kind of suspected we would go somewhere around 15.9, 16,000 was my kind of call. I thought we'd get somewhere up in here, but anything in here is certainly still resistance. It's a clear breakout. Weekly still look really good, but we're coming into these highs. And you'd say, what recession, what problem? This thing has come back like an animal. Is come back very strongly. And you can see here what happened October all the way. You might think the US has done well, but when you compare it to these markets, you're up 33.6% off the bottom. So the DAX, the France 40, the FTSE, all of those markets have done quite well. The Australian market, for the Australian viewers out there, remains at these highs, waiting for probably more US information. If copper continues to fall off, don't expect the Australian market to do well. However, it is right at these highs now. So nothing to be determined here. The trend is currently up. You wouldn't necessarily be scared of it yet, but we're waiting and seeing. So trend is up, looks okay. Let's move over here to the Qs. The Qs have not taken the high. While the S&P is kind of flirting with higher highs recently, the Qs instantly got up and then started to consolidate. Now, let's just think about conspiracy thoughts process here of what Wall Street might want to do. They pushed the Qs up quickly, not allowing as many retail traders as they would want, as people would want, or retail traders would want to get in. They move the algos quickly. Then they create, now it could be accumulation or it could be distribution. So if you think about this as distribution, let's say we now took that high and did that. Do you know how many people would be rallied in and have bought in this area? It's spent almost more time in this area now than it has in the entire rally. So basically there's going to be a lot of retail traders buying these dips, buying these 0.3% moves, and then they're not used to necessarily, the 3-4% that we've seen before. So remember, it's to be determined, basically. We don't know whether it's distribution or accumulation yet, but if we do breach out and we get closes, remember close is the key in this case, then we're moving towards these highs, probably looking at taking those out. So the Qs sit at a pretty critical level. We're looking at it. Let's move over to the US 2000. I want to just look at this. You can see here, not the 3000, but the 2000 is fast approaching the critical zone again of 1800 or 18,000 and 1810. So 1810 is a zone that we've seen plenty of sell-offs from. It's coming back. It's shown us some weakness here, but it keeps just buying that last hour. Like the last hour just keeps rallying up. You can see here the rally that comes through in the last 2 hours here. And yeah, it just keeps doing it. It's making series high lows. Maybe it's looking to breach. That could play into the idea that it's a Wyckoff accumulation. It's all happening. We're right at these zones. I think we'll find out very, very soon. US 100 futures, you can see the kind of up, down, up, down, up, down, up, down. We thought we'd find weakness in the previous session. We did for most of the day and then just rallied that whole thing back. Again, watching reactions up here. If you're a scalper, you're going to want to mark all of that in your charts. And if you're a day trader or swing or anything like that, you're probably waiting more to see the next move. Unfortunately, it's boring, but there's been other market moves. Currencies have done well. Gold's obviously moved. Dollar's starting to move again. So there's always another opportunity. Let's have a look at the SPY. We can see here the SPY is still stuck within long leg doji, the high and the low. SPX will show the same thing. Now, somebody's mentioned before in our Discord room that supposedly there's like an average amount of time that's been taking from the bottom to the highs. So we're looking at like 43 kind of days. And those rallies seem to be fairly, consistent. So about 40 to 43 days on the up, on the down. And if we actually mark out from the bottom to the high right now, we're only sitting on 35, 36. So maybe we've got a couple more days of stuffing around. But yeah, it seems like anywhere between that 40, 43 days, a few people have looked at all of these rallies recently and they've kind of marked that out. Is that anything to take from? Probably not, but something that is interesting. Downward trend line still intact. Maybe you could say that's a little breach in the last 24 hours, but still no new higher high. We know 4180 close will be significant on the S&P 500. So we go over here to the futures And this is where we thought would sell off on the weekend video. We saw the sell in the morning and then just boom, that last 2 hours. Look at that thing, just straight back. The animal spirit of the bulls. You guys just V-shape every drop. If that doesn't hold though, imagine if we go like this underneath that one. All of a sudden, we're starting to look very negative. And of course, we know that 40.68 is the true problem for the markets because we have that trend line that comes through. We have extensions that sit in there. We have the lows that were formed previously over here. So we've got that high, low, higher, high. And if we get under here, we make a 2-hour switch trend down. So at this point, we are still theoretically in the bull run. We're at a critical zone. We could be still at distribution or accumulation. A lot of people are now going bullish. I just haven't seen this level get taken yet. So until that level gets taken, what can we do? We just have to look at it using both processes. And we have to say, well, we have these bullish looking candles. It looks like it's grinding up and certainly does. Looks like it's getting ready for an explosion on the upside, but it could easily just trick everybody and go the opposite way. So I prefer to remain neutralized here with, of course, a negative bias, mostly because we know we're at the negative bear zone and we take either position. We take either side depending on the information on hand. And we don't have a sell trigger just yet. We did have one on Monday, certainly a sell trigger towards the negative side, and it did sell off immediately. It ran for most of the session and then just recovered back. So yeah, it is what it is. We're still kind of around that area. And we will find out. I think Netflix, maybe it's Tesla. One of these two earnings should get us. Remember, we have 1, 2, 3, 4 gaps underneath. That's not insignificant. It's one of the biggest reads of gaps I've seen in a while, leading into the big options expiration. 3.385 million units, 402 max Payne, current price almost 414. So theoretically, if Max Payne's even going to partially work, this is the only week you really look at it, it is pointing towards the negative side on markets. And with things like breadth and everything else kind of showing us that we've got some extremes, that could be a real deal. Also, Bitcoin has shown us some of those ones. Now, Bitcoin, we definitely, this would end up being the better trade. I was really negative on it here. It certainly moved through. It's actually taken out this low. It's come into this block, which is probably an order block. And this area here is now getting rejected. So let's have a look at both sides. The bullish side, you're probably looking for it to go past something like 29.60. So that should theoretically remain actually bullish. If the markets go negative here, though, again, just further sell off, and maybe that's kind of a reflection on the markets themselves being weaker than you think. If we go to a 2 hour, I just want to show you where it actually ended up going down to. So let's just quickly zoom that out. Oops, what am I doing? I don't want 2 hour. We'll go 15 minutes. Okay, so you can see here, the market actually goes straight into this demand. So this is clearly that other level of demand. So we went past this, instantly into this, makes sense. Found some buyers, okay. I could still see buyers recommencing if we get through 29.6. But is Bitcoin showing us the future of the stock market? I mean, it has actually already started to weaken. If we just see this continuing to sell off, you've got to think stocks might come as well, because this is kind of like that ultimate kind of growth asset that people look at. Maybe it can be considered the technology or something. We've seen these run kind of together with each other. So we're still at that little bit of the bulls are there. I really like that from a target perspective. So I think congrats if you got the sell up here, well done. But here I'm open to still buyers recommencing. But at the moment, looks like sellers are still in control. So the sellers actually pushed through from our critical level. I'm very happy to see the bears actually commit there, because I thought they would, and at least they have for a few thousand. I'd like to see more. I'd like to see this market back in, of course, in the low 20s. But yeah, that little rejection there with that wick, I'd be looking over the next 24 hours at what happens in here. I think that's going to be very, very important. Let's move over to the news. What have we got going on? We have a few bits of information coming out from different other countries around the world as we go into earnings season, CPIs, etc. They may move the markets a little bit. Then we've got unemployment claims Thursday, April 20th at 8:30 a.m. And then we have flash services PMI coming through 9:45. If it's your first time here and you haven't followed any of the other social medias that we have, or even if you've been joining for a while, why not consider following us on some of these? You can get more up-to-date information. And of course, we share different information through our platforms. Also consider the 3 free trading cheat sheets. It's as easy as, of course, clicking on it, just putting in your email address and getting a copy. Thanks so much for watching, guys. Thanks for subscribing. And thanks for making this the best community on the internet. Bye for now.